Welcome, everybody, to the Investor's Journey podcast. My name is Josh Klein, and today I have a very special guest, a member of the oil and gas industry, someone who's been in the field for many, many years, has great insight, Doug Hardwick. Welcome.
Thank you very much, Josh. Pleasure to be here.
Yeah, it's great to have you. So, Doug, you have a very unique background. My background is more on the traditional finance, real estate side of things, and you have a oil and gas background with a tremendous, rich history of a lot of knowledge. So, I'm excited to have you here to talk about your thoughts about the industry and how investors like myself, who might not have that background, get involved in the space. So, why don't we start off by talking a little bit about your background? Where do you come from? What's your experience, and where are you today?
Yeah, well, my mom is from Ohio. My dad's from Abilene, Texas. And I remember going to our grandparents' house. I grew up in Ohio, but I remember coming to the grandparents' house and there was an oil well out the back window. And you just watch that old pump jack, as they call them, or rocking horse just going up and down. And, really didn't think much about it then. And then we moved to 268 acres there in Ohio. We had three natural gas wells, but they weren't your traditional well. These were storage wells actually for Columbia Gas. And I remember in 1978 we had this big old blizzard, and electricity was out everywhere. And we were able to take the pressure, the natural pressure from those wells to keep our furnace going. And because we had a natural gas powered furnace, and we invited our neighbors up because they had absolutely no heat at all. So, you think about all that. And then later on, I'm living in Texas. I came actually here. I wanted to live in Abilene, and I did construction a couple of years there, and then came to Dallas. And through a lot of different circumstances, ended up working for an oil and gas drilling company. And so, you think about, well, all those things I thought about when I was young, and now I'm actually in the business, not on purpose. You'd asked me a couple of years prior, 1999, I would have never guessed I'd be in oil and gas. And by 2001, I was.
Mm-hmm.
So worked for drilling companies for several years, for about the first 15 years, and the last 5 or 6 years, just strictly minerals. And so, we can talk about why just minerals, but at the end of the day, it's been a very, it's been a lot more success owning minerals as opposed to drilling a well and trying to find the oil. Let somebody else find it.
Yeah. So we'll go into the mineral aspect of the business, but if you don't mind educating the viewers, educating myself, what's the overall, in a nutshell, process of the oil industry to get from extraction, finding extraction, and then to get to my stove or the
Yeah,
gas in my car? How does that work?
yeah, right. So uh, there's I tell people all the time. Actually, I was just had lunch today with a friend here in town and my daughter, and I talked about this a little bit. Is that the oil and gas industry probably is the biggest consumer of technology of any other industry. We have, they call them streams. You got the upstream, midstream, downstream. And
Mm-hmm.
so the upstream is the part where we go find the oil and natural gas and drilling it and getting it into the pipeline. Well, the pipeline are the trucks to haul the oil, the pipeline for the natural gas. That would be considered the midstream. That's your pipeline infrastructure. And then you go into, then you have the refineries. And then the downstream is where you take the refined product and send it to market. So, and then there's some companies that have just, are just midstream, just upstream or downstream. Companies like ExxonMobil, probably been to an Exxon gas station. Well, they
Yep.
also drill wells. And they also have their own pipeline, and they also have their own refineries. And so that would be what some people would call a vertically integrated company. where they just handle the whole cycle of the product.
Hmm. So historically, which component of the process has been the most profitable from an investment standpoint?
That probably uh, depends on who you talk to, I think. Um, there's, you can, if you hit a big well, that could probably be the biggest return on investment of any of it. But if
Hmm.
you have a very successful refinery, refined products, selling the polymers and all the, I mean, I think people would be amazed if they sat back, looked in around in their room, whatever building they're in, and I would be hazard a guess that 100% of what you see is there because somebody first drilled an oil and gas well. Because all of our
Hmm.
plastics, our paints, varnishes, metal, all of that is because somebody drilled an oil and gas well.
Hmm. So what's interesting is the overall cyclicality of the oil and gas
Yeah.
industry. The prices just last year, oil was doing very well, and then kind of towards the end of the year and into this year has underperformed many other asset classes. So, what do you say is the main cause of some of that major price movement and cyclicality in the overall industry?
So there's two. Yeah, I mean the the cyclical nature of oil and gas is actually what drove me away from actually drilling wells. Because when you're out there producing the oil at the oil well, you have a lot of expenses. They don't go up and down like the price of oil and gas does. So when the price goes way down, uh, you're going to be selling oil for less than what it takes to get it out of the ground. So, that's difficult for small operators, like where the segment that I was in. Um, but as far as what causes the price of oil and gas to go down, we all learned in high school the law of supply and demand, right? I think that's going to have the biggest effect on the price of oil and gas. That's what's going to make your oil go from $50 a barrel to $100 a barrel. But you've got geopolitical, and
Right.
that's going to have some effect. And the traders will can move the price of oil 2, 3, 5%, in a day, just based off of news, but not fundamentals. And so that can have effect. But some geopolitical events, like what we've seen in Russia and Ukraine, that can make a big effect on that. I think is what spiked the price of oil a couple of years ago to $100 or near.
Hmm.
But yeah, it has pulled back quite a bit.
Yeah, because it's interesting because on an inflation adjusted basis, oil is really not materially higher than it was 10 years ago. It's basically been, for the most part, flat with a handful of spikes here and there. I mean, we saw over $100 a barrel, and now we're much lower now. So, what do you have to say in terms of the potential deglobalization or de-dollarization? Now people are trading oil in their own currency. There's, of course, some tension in the Middle East with the Israel and Hamas war. Like you mentioned, the Russia and Ukraine debacle. What would you say is some of the predictions you believe for the price of oil and how the global flat factor plays a huge role in what we see over here in America?
Yeah. Well, if I could predict all that, I'd be the richest man in the world. But there are some things that you can look to and see and make adjustments on. So yeah, bricks, I think is what you're referring to, and they're trading oil not on the U.S. dollar, what we've called in the past petrodollar.
Hmm.
So that you know, I've read both sides of the coin on that, and I'm not an economist, and I'm not an international trader, so I don't have the best grasp on those things. I do keep my eye on it, and I read about it. That's why I hear both sides of the coin. So
Hmm.
some people say it won't affect the dollar. Some people say it has already affected the value of the dollar. And so when the value of the dollar goes down, well, that makes our commodity prices here in the States more expensive.
Right.
And what you were referring to with the valuation, you look at 10 years ago, and I try to look at, based on, the value of the dollar and what the price was. And I think that oil prices around $70, 73, somewhere around that nature is about average price. So right now, today, we're sitting about average, I think. Um, but natural
Hmm.
gas, I think you're seeing is a little bit higher. I think the average has been around two and a half. And it's funny, most people don't pay that close attention to natural gas. They think oil wells, I just want some oil. But, we're pretty big on natural gas too, because, um, well, with, the pipelines being blown up and Russia not being able to ship, and just read earlier today that Russia was trying to get an LNG port going, and the sanctions have prevented them from moving forward as quickly as they want to, if at all. So,
Hmm.
that's going to, I think, um, benefit the United States market because um, Germany built 3 new LNG import terminals. Um, Poland signed an agreement to import LNG before 2020, which kind of put that on the back burner until the market came back. Um, so there's going to be a lot, I think, of natural gas export in the form of LNG, liquid natural gas, and
Hmm.
there's ports being built all over the Gulf of Mexico right now to export natural gas. So I think in the long run, I think natural gas is going to be a pretty good bet, and I think our average price is going to be the probably closer to the floor than anything else right now.
It's interesting you talk about some additional exports and building out larger infrastructure in many other countries to support the potential growth of the need of more energy.
Mm-hmm.
Something that's been very interesting that could potentially, in my opinion, drive the price of these commodities higher is this whole ESG component and outlook from a political spectrum. And ESG is the sense that we have to worry about the environment, which rightfully so. Of course, it should be at the forefront of our mind for ourselves and our children and the next generation. But it's caused um, a sense of fear to invest constantly in the oil and gas industry. And as a result, we are widely undersupplied of the necessary infrastructure to really maintain our energy dependence. So what do you think about the whole ESG fear, and how is that going to drive our ability to meet the demand that we might have over the next 10 years?
Yeah, ESG, environmental, social, and governance.
Hmm.
So yeah, I the social and the governance, I think those are good. The social aspect, I think the best part of the whole ESG movement is that I think more people are paying attention to the social issues, which I think is very important. As far as environment, uh, and it's caused some banks not to fund some oil and gas projects. And then you've got politicians saying that they're going to shut down oil and gas and stop it, and we don't need any more. And um, if you're an investor and it takes 10 or 20 years to get a return on your refinery or your pipeline, yeah, those things aren't going to get built if they're being told they're going to shut it down. And so I think you're going to find that come to a head here pretty quick. Um, Probably towards the middle to end of this year, I think it's going to have a real big effect, especially as the LNG terminals get put online. The supply and the demand on that's going to be, I think, in the positive side for higher prices.
Hmm. So what's interesting is you speak about banks not willing to fund a lot of oil infrastructure. So a lot of oil and gas services companies are essentially charging very high prices to
Right.
maintain these wells, given that there just hasn't been a supply or the infrastructure to support the growth. So, what do you say in terms of the actual demand of oil and gas in the future as we shift over to solar energy, maybe some nuclear energy, wind, and then, of course, electric cars, Tesla? Do you see demand falling off a cliff in the near term?
Yeah. No, I don't. And I think so. You look at last year, we hit record high production in the fourth quarter. That happened, and we can touch on this a little later, but that happened with uh, more than 100 drilling rigs laid down last year. And so I think there's, some fundamentals coming into play that most people, I don't think, look at too closely. But when you look at the supply and, the supply and demand right now, I think is a lot of the lower prices that we have right now, especially on oil. Gas recently this year you look at year to date, it's gone up quite a bit, from about $2.50 to $3. It's pulled back a little bit, but oil, I think, is a lot lower than fundamentals would support. So,
Mhm.
yeah, I think you're going to find, and there's a lot of, you talk about this all day, but suffice it to say, there's a lot of companies that have gone to private institutions for funding, and but it's still not enough compared to what our needs are. Now, my personal opinion when it comes to wind and solar, I don't think people realize how much oil and gas is required, and coal, to make windmills, wind turbines. There's massive foundations of
Mhm.
rebar and concrete, and then solar panels as well. I believe that if we had just stuck with natural gas and nuclear energy 20 years ago and not done any oil, wind, and solar, that our consumption would be lower today. I think those apparatuses require so much oil and gas that that's why our consumption is actually, worldwide has gone up dramatically in the last few years.
Yeah, that's interesting you say that because as we speak, uranium, which is a very important component of nuclear energy, is at all-time highs now at nearly $95. So it's up many hundreds of percent over the past 2 years because of this newfound interest and almost requirement and need for us to make sustainable energy because oftentimes wind and solar are not reliable. So
Yeah,
it's just interesting to see those two perspectives. And so I want to speak a little bit about mineral rights. So I know
sure.
you've switched over a lot of your efforts to building a mineral rights company, selling mineral rights to people. Do you mind explaining a little bit about what is a mineral right and how
Sure.
it could be beneficial for the typical investor like myself?
Yeah, it to me it's kind of funny that mineral rights is like that key word, if you will. People talk about mineral rights, but mineral rights is simply the right to extract the oil and gas and sell it. And so the only person that has that right is the mineral property owner. And so if you own the property, then you have the mineral rights if you have the mineral property. And one of the fascinating things here in the United States that most countries don't have is that the landowner can also own the minerals, but they can also be severed. And many states in the United States allow the landowner to separate the surface from the subsurface. So if you own just the mineral property, well, you can't build a cabin, grow cows or crops, but you can extract and sell, and the landowner can't prevent it. Now you can't just go in and tear his property up, but there are certain rules and regulations. But one of the things that we have done as a company is we focused in property under specific oil and gas companies. And so we look at these billion-dollar companies because they have the wherewithal to make sure that they follow the rules and regulations and to be able to, drill and operate these massive wells that they drill today. They're about 1 or 2 miles deep, and they'll be 2, 3, 4 miles long. And it's incredible, the technology of drilling and operating wells today. But, that's one of the key things that we look at, so we don't have to worry about, or is everything done properly.
Hmm.
The other thing about mineral properties that I love is you don't have any liabilities or expenses out in the field. So you own the minerals, well, you own the oil and gas. And so the oil company is responsible for the oil well, and they're responsible to get it out. Since we don't own any of the surface, we don't have any liabilities or expenses that the surface property owners have as well. So there's not even an insurance policy for subsurface mineral property. So you
Yeah,
cash your
it's
checks
pretty
and pay your
remarkable. And so I guess talk a little bit more about mineral right valuation and how it works in terms of a revenue royalty share. Because like you
tax.
mentioned, you could have the surface and the subsurface. Similar to real estate, you can have a ground lease where you own the actual ground, and then you can have a lease of just the building. So you
Mhm.
can essentially bifurcate the interest as you go down under the surface, and now you can have a mineral right owner. So talk a little bit about owning the subsurface land, and what does that mean in terms of a revenue share, royalties, and how do you potentially value that from a cash flow standpoint?
Sure. So, uh, different states have different rules and regulations, actually. I was just speaking with a fella, late last week, and he didn't realize that because we're here in Texas and the mineral property rules and regulations here in Texas different than Oklahoma. Those things, especially when it comes to, well, how much is it worth? How much is my
Hmm.
mineral property worth? And so we look at two different things. We look at, one, how much money is it making? And number two is how much oil and gas is still on the ground waiting to be extracted and sold. And so those are the two biggest factors on what's the property worth. One is getting you money today, the other is getting you money tomorrow. So long term money. That's what we're looking at.
Hmm.
Generational wealth, as some call it.
So what's interesting, and so I own, full disclosure, I own mineral rights. I bought from Doug, and it's been great. I've enjoyed access to the industry. Um, within the oil and gas industry, there's this sense of kind of like a hockey stick of return, where you typically, when you drill oil initially, that's when the reserves are going to be the highest, and then
Mm-hmm.
over time, the reserves are depleted. So in terms of the future cash flow of a mineral right, it'll eventually go down to nothing over time. So the hope is, and I know you mentioned a generational asset, which is that's interesting. Can you speak a little bit more towards owning the acreage, the potential to drill more wells, and the life cycle of a particular well?
You bet. I think one of the things that really separates us from a lot of companies is we think about what's this property going to be doing in 100 years from now. And so, uh, oil wells, they start out really high production, then they have that decline curve, right? And the steepest is the first 6 to 8 months, and then it's really kind of gradual after that. You know, and so that's why I don't like owning oil wells, because once the oil well's done, it's done. Whereas on mineral property, what we're looking for is early stage development. I had a guy bring me a property a couple of years ago, had 12 producing wells. But the problem
Wow.
is he's in an area that there's just one pay zone, one layer of earth that has the oil and gas. And so that property has no future except for what it has today. And once those wells dry up, your property dries up, unless they can come back in. And we can go through that in a minute regarding technology and refracking. But as far as the property that we look for is that one pay zone, we only want just 2 or 3 wells in it, because now we know for a fact that they have to drill more wells to get all of the oil and gas out. So now we know that even if our returns are here today, they add more wells, we get a higher return. We make more money. But
Hmm.
here's the other thing: is there's a little thing in the industry called stacked pay. I think of it like my grandmother's 6-layer cake, right? You got 6 layers of good stuff, 6 layers of oil and gas, and each one of them is its own pool of oil and gas. So once they drain the one formation, now they can move down to the next formation or up to the next formation. So they have all these different layers that they can go back and drill more as the first formation dries up. Some properties can produce out of 2 or 3 formations at a time. Some produce just one at a time. And what I've learned is that you can't second guess an oil company and figure out what they're going to do, because they may do one thing this year and do something different next year. So, it's hard to second guess. And these billion-dollar companies, probably with millions of properties out there, it's really difficult for them to come to a little mineral owner and tell you what they're going to do next and when they're going to do it.
Right. Now, so what's interesting is that you own the subsurface land, and you have highly incentivized billion-dollar oil companies that are drilling for wells in multiple pay zones that could get today a 10 or 15% return depending on where oil prices are. But then the hope is the future that they could either hit a new pay zone, drill a new well on your land, because I don't know if we mentioned it, but one mineral right is typically over a number of acres, right? You could separate your mineral rights into, I think it's over 620 acres per land. Is that correct?
Yeah, pretty close. So in specifically in Oklahoma, they divide the mineral property into sections, and one section is 1 square mile or 640 acres. And so, you can go in and buy just an acre at a time of these mineral properties. And so you buy 1 acre, 2 acre, 10 acres, whatever's available and that you can get. It's tougher now. And people always say, well, how do you get, the best acre, and why would somebody sell something good? And, people sell good stuff all the time because they can make a return on the sale, right? But that's what we do, is we're looking for that property. Our number one criteria, once we have the area of interest, which, where's all the big wells with multiple pay, is number 2 is who's the oil company. And that's our number one criteria, is who's the oil company. And we have a group, Mineral Royalties Group is our company, and we're a group of oil and gas professionals that know how to evaluate how an oil company drills and fracks and operates wells, to determine if we want to buy property with them as the operator. Because to us, that's probably the number one criteria, who the operator is. Got a bad operator and the best property, you're not going to make the money that you could if you had a really good operator. So, there's a lot of due diligence on our end that we look at and try to determine whether or not we want that property or not. And then the hardest part is finding somebody who's willing to sell.
Yeah. So just to close off, really, you mentioned your company. What would you recommend for the viewers that want to learn more about mineral rights investments, want to learn more about the oil and gas industry? What kind of resources can you provide them, or pieces of advice for them to learn a little bit more?
Yeah, the challenge, with the internet is you don't even know where truth begins and ends sometimes. So it's really difficult. And what we've done is we have a website where we have a lot of resources at. And then we also have a YouTube channel that I never would have guessed I'd do that. Of course, I didn't think I'd do a podcast either. And here I am. Right. This is my 3rd one. So how
Nice.
about that? But the YouTube channel, most people don't realize this, but they have a description of the video. And in that description is where I put, the information because I only do 60-second videos. I try to keep it real short. But down in the meat and potatoes of the videos down in the description. And if I'm talking about specific facts and, where did I get the information, I'll have a hyperlink to that website. And so that way you can kind of see where the information comes from, to make sure it's a legitimate company, not some, kid in the basement throwing something on Wiki or something. Yeah. So yeah, we
No,
try to
that's
be
great.
educational on that side.
That's great. And I'll in
There
the
you
future to
go.
come and your email, and I could share that in the link in the bottom.
Awesome. Well, I
Thank you,
appreciate
Doug, so
that
much.
very
Thanks for
much,
being here.
Josh.